Expectations for global central bank rate policies feel starkly different right now compared to at any point in the last 5 years. Now, early on in that period, central banks eased in unison to counter the sharp 2020 slowdown from the COVID pandemic. By 2022, though, most were eyeing rate hikes to tackle the rising inflation that ensued. Now, 2025 marks an era of central bank desynchronization, the threat of a global trade war with the US and China as the key players take center stage, potentially pushing central banks in opposite directions. Now, this could significantly impact currency pairs. Central banks like the ECB are likely to lower rates in 2025 alongside Canada and Australia, while the Bank of Japan has been raising rates to address rising wages and persistent inflation. Many market forecasts indicate that China might cut its interest rates if the trade war with the US begins to hurt its economic growth. Meanwhile, the CME FedWatch tool currently projects 3 rate cuts from the Fed by the end of 2025. Now, I've already seen some striking moves in currencies in 2025, with the euro up 10% since January 1st, the pound up nearly 9%, and the yen gaining an impressive 11% against the dollar. So far, these shifts seemed more tied to US trade and economic policies, but the currency market could soon pivot to focus on rate differentials for the next wave of the moves. Of course, the biggest unknown remains the ever-evolving tariff policy. Global markets have been clear regarding who does not benefit, but they seem a little less clear about who could benefit. Now, if trade conflict persists, perhaps countries that are early to the bargaining table could see a boost in economic activity, potentially altering their rate paths and their currency evaluations.